So thank you everybody for coming out. I also want to say thank you so much to Benzinga for hosting these local events. I think they're awesome. Market spotlights are an amazing way that we can all get together in California. So I'd like our panelists to introduce themselves. Dustin, would you mind introducing yourself first?
My name is Dustin Milner. I'm the Chief Executive Officer at Talaria Brands. We're a vertically integrated house of brands here in California, cultivating, extracting, packaging, selling, distributing to about 330 retailers with our flagship brand, Cream of the Crop.
I'm Dennis O'Malley. I run an advisory service called ECTRA, it means Journey in Gaelic, with Hannah O'Brien. And we help companies across the country go through kind of major milestones. A lot of it's turnaround, some of it's growth engines. Previous to that, I was CEO of Caliva.
Great. I'm Rachel Wright with Verdant Strategies and 420 CPA. We serve the cannabis industry, tax and accounting and advisory. How about Steve Podell? How about you?
So Steve Podell, I am co-founder, CEO of High Road. We are the front end of distribution representing brands in California. In the near future, we'll be in other states as well. And then also, I'm a partner with Cypress Ascendant. It's an investment firm down in San Diego, and started a fund with Cypress to focus on cannabis businesses for service and technology in the supply chain.
And Evan.
Evan Henneman, founder and CEO of Sands Lane. We're a strategic advisory firm, creative agency, and venture studio, and also operator and CEO of Harmony Craft Beverages, which is a beverage-focused, non-alcoholic and functional beverages platform as well.
Thank you, guys. Okay, so let's kick this off so we can set the landscape here for base terms. Dennis, do you want to talk about, for example, debt capital, investor capital, any other kinds of terms that you feel like people need to know?
Yeah, I mean, I think there's so many smart people here who deal with this every day, but I don't know a cannabis company, and I haven't been in a cannabis executive meeting that doesn't sit down and say, okay, what is our capital strategy? And I think for those who are going through the basis of, I need cash in my business, there's just a lot of different options. All of us have gone through those creative financing basis, which is, did we do the PPP loans? Did you do ERC? How did you sell bulk, in product to be able to go get cash in the business? Cash is the oxygen of your business. And if you're saying, how do I get access to that? There's cash out there. It might not be the cash you want, but there's cash out there. And how do you actually bring it in? Is it equity? Very small pockets and pools of equity out there. Is it debt? What does that look like? If it's debt, what are the terms? Is it through a partnership? So I think the creativity that you have to have when you're looking at this really starts from, what do you need? Why do you need it? But there's so many different, I'd say, scenarios that are really important for operators, and then just same thing for investors. I know we'll talk about that too, and just in terms of what type of investments that you're looking to make. The types of investments that I've made have been some equity investments, some short-term debt investments, and it's a lot of different deal flows out there. Very few companies, I think, that fit the bill to really take on an investor versus having something like a debt loan, et cetera.
Yeah, how about EBITDA? What is EBITDA? Do you want me to say what that is?
Well, I do think when you are raising money, the basis of something as simple as profitability can mean two different things to two different people. And the expectations that you're setting when you are taking somebody else's money, that they expect not a 10% return, but sometimes a 10x return. It's just that what those expectations are and what milestones look like. But as an investor, you should have as well those same expectations that says, hey, if I'm investing here, this is for growth capital, not for operating losses. And defining what type of profitability is, adjusted EBITDA, cash flow profitability, et cetera, are important to do.
Awesome. And how about like market risk?
Well, I think market risk is so tough in this industry. I'm come up from north in Silicon Valley, and we celebrate and talk about $4 million of equity investment that likely had been open for 18 months and was converted from a whole bunch of convertible notes that go into growth capital. That's not enough capital. I think there's a lot of people that have talked about how much growth capital that you need in the cannabis industry, but there's significant risk on it. And so that's why you see some predatory loans and some lenders out there who'll do 36% APR on some loans, and people take it because that's their only access to capital. And that is such a significantly high cost of capital that will destroy our industry. And it's just not like that in other industries because the risk profile isn't there.
Yeah, I totally agree. Any other terms that you feel like we need? Oh, go ahead. Does anybody else? No? Okay. Any other terms that you feel like we need to set the landscape for? Or?
I'm sure there's going to be a buzzword bingo that we'll have people complete. So.
I'll throw out one term actually that might be helpful is cash flow. I think that's one thing we overlook a lot when taking on investors, especially when looking at debt. If you can't service that debt right now at 36%, you're not going to be able to service it in the short term. Not the right instrument for you. So pairing up your need with the instrument might be driven by cash flow or something else in your business. So make sure you know what you're trying to get and why before you start taking either debt or equity.
That's a good one too. Okay, Dustin, how are you?
I'm well, thank you.
Good, good. Do you want to set the landscape for, it's just the landscape in California right now for investment for businesses, please.
Challenging. I have been, I've raised a little over 10 million in capital over the last 12 months, and what I can say is the landscape in California is wrought with hurdles and challenges and objections. And one of the things to consider if you are raising capital is that an investor is not just looking at your opportunity, they're looking at every opportunity. That includes other opportunities in California as well as other opportunities in Missouri and New Jersey and New York and every other state in the country. Not to mention just opportunities, not just in cannabis, but also in real estate and other plays. We have taken a distressed asset consolidation approach, and so our pitch to investors has been California is there's a lot of opportunity in California because it is being ignored by investors, because there's headline risk in the news that you'd flip on any news channel, and pretty much everybody outside of California thinks California is a disaster. So as a result of that, there's very little investment cash that's coming into California, and most of the institutional investors already have, they've already hit their saturation for their portfolio dynamics on how much they can invest in California. So the pitch then can become, California is it's a very opportune time in California because there's lack of access to capital and lack of capital. Thus, valuations on businesses are at historic lows, which creates opportunities to consolidate assets at below true market value. So I think the landscape right now is most of the quote unquote institutional investors or professional investors in cannabis, especially in California, have placed bets early on. Many of those bets have not panned out and have not won. And so many of the investment funds have taken losses as a result. And there's been several companies over the last year that equity investors have gone to zero. And so that has shifted their ability to raise capital. So today, if you own a cannabis business and you're looking at raising capital, you really have three options. You can identify an investment banker that hopefully has access to people outside of the traditional network in cannabis. You can go friends and family and work your own network, which is what I have done and recommend doing. Or you can take debt. But as Dennis alluded to earlier, debt comes with all kinds of additional hooks, such as the security instruments. And most debt providers are senior secured, not to mention it'll come with warrants, so they'll have a right to purchase equity in your company at a discounted value. And it will also come with a well above market interest rate. In some cases, APR is being 20 to 30, even more than that percent. So the landscape is challenging, which is, if you are raising capital, it's certainly not a 1, 2, or 3 month process. Oftentimes it's a 6 month, 12 month, 18 month process. And most of the time the individuals that you raise capital from will not be your first-hand contacts. They'll oftentimes be second, third, or even fourth degree separations from your initial conversations. So it's a challenging landscape, but there is a lot of opportunity. And for those of us that are still operators in California, that are still waking up every day and making it happen, I think we could all, when I look out at the landscape, the individuals that are still here in 18 to 24 months are going to be very, very well positioned to ride an upswing in California when that does happen.
So on that note, what are the opportunities if you hang for that period of time, 18 to 24 months? What kind of opportunities are there on the other side of rescheduling, for example, potentially?
Well, there's a lot of things that are happening on the federal landscape, none of which I think we can throw a dart at. Rescheduling, we'll find out on December 2nd, and so we'll see. But opportunities as we go, the way this industry is going to shake out here in California is we're going through a period of consolidation. So what that's going to look like is companies are going to go out of business. There's many retailers that are already struggling to pay their payables, let alone payroll. That will continue to compound until enough retailers go under and enough suppliers go under that the market right sizes itself. We meet a supply-demand equilibrium, and there's enough then foot traffic going to retailers that are effectively managing their P&Ls and managing their cash flows to pay vendors. But until we get to that equilibrium, there's going to be some pain. So it's as I've been operating a brand since 2018, and one of the top things that we do is we manage our cash flows, and most importantly, we manage our credit risk. Credit risk can be, I think, the single greatest threat to any operator in cannabis, which is the risk that you sell a product to somebody and never get paid for it. And so I think the next 18 months we're going to see a lot of credit risk unfold negatively for a lot of people, but ultimately that has to happen when you have an industry of this size that's born out of the shadows. There's going to be competition, and it will be survival of the fittest, and I think that's what we're seeing now and will continue to see. But once we get on the other side of that, the relationships that are established during the difficult times will bear fruit, and it will be a good market to be in long term. At the end of the day, California is still the largest cannabis market on planet Earth.
Yeah, the only other thing I would say in terms of creative financing options, Dustin, because you're right, if you're in California, you're limited options, especially if you're plant touching for that. But I've seen a number of different California brands get really creative, and I think Kyle did a good job in the opening keynote talking about that. That have actually licensed their product in other states that have great margins. And so while there's a race to the bottom here in California in terms of how low you can actually price something and how much THC and product you can get into something and what that looks like in a value play, you go to other states of Missouri, and that same vape pen that's selling for $25 to $20 here is selling actually for $100 in Missouri. And so I've seen really innovative, creative California brands go out and license, partner, and go to other states to be able to go drive from an operational basis what that looks like in more profitable areas. But certainly their headquarters are still in California.
What are you guys' experience right now in the California cannabis market and investment? Opportunities, challenges, weaknesses?
Well, everybody's afraid of California. I mean, it's a tough state to operate in. We have compliance, we have taxation, and I think to have a income statement, and EBITDA, look appropriate. It's just very challenging. So, from a standpoint of being a company, it's really having your operations down. Actually having strategy behind it, and just being linked up with the right type of investors, but. From the perspective of, if you're, in retail or cultivation and some of these, challenging businesses, it's hard to find the good ones, but there are good operators out there, and, you just got to do your due diligence.
Great. Yep, Evan.
What I'll add to that is, in California, I would say bona fide battle-tested operators, which is something that you don't have in most other markets. And Dennis, we spoke about this before. The amount of, I would say, wounds operators have taken in the last eight years or so is actually something that is a strategic advantage as you're positioning yourself for investment. Vice versa, from an investor standpoint, you want a team that can operate in the worst of times with the thinnest margins. Well, that's really who you're going to find in California right now. How that replicates how you build a playbook to go into new markets, that's a function of, is the team ready to scale? Is the team understanding of how markets will work outside of California? And then ultimately how those markets pan out is who can operate most effectively in the downturn, not who can operate most effectively in the upturn. So positioning yourself now for that is a good place to be. It's hard when there's no capital and when the supply chain's drying up, you've no retail doors. But as you're going out to investors, that is really a big part of the story that they're looking for. So,
and on that point, so he makes a very interesting and very valid point, which is if an investor is looking at investing, if you're an investor and you're investing in a cannabis business, and you're looking at New Jersey or you're looking at Missouri and you're seeing that margins are off the charts, and the same vape cart that's selling in California for $25 is selling for $100 in Missouri, that's great right now. But you know that the challenge or the risk in that is anybody can make money when pounds are selling for $2,500 or vape carts are selling for $100. And what we've seen is every legal market follows the same life cycle with the exception of limited license states. Where an indoor pound of cannabis is $2,500 on average for the first 3 years. The second 3 years, it drops to $1,400, and the third 3 years, it drops to $11. So if you're an investor looking at investing in cannabis, unless you're planning on exiting within the first 3 years, investing into a new state where margins are heavy, you're betting that that operator not only knows how to make money with really healthy margins, but also knows how to survive and make money with compressed margins. Versus in California, the operators that are still here, especially if you've got a positive cash flows, positive profitability, these operators have figured out how to turn a profit in the world's most competitive market while it's compressed. So I think there's a lot of value to what he just said, and if you're an investor looking at the space, that's why California operators, especially today, are a cut above.
I'd take a little bit of the opposite view on that, though. There's a famous debate of economists between Adam Smith and John Maynard Keynes about economics and equilibrium and supply and demand, and the net of it came in and said, hey, Adam Smith, you're going to be right, but that's the long run, and in the long run, we're all going to be dead anyway. So the challenge is just timing, and you're right in the long term. But as an investor sentiment, when you have expectations that says, I can actually go clip cash and clip a great return in cannabis, and it's short term in the next 6, 12, 18 months, that's risk adjusted lower than it is in every place else. That's the challenge in terms of that any California operator has in terms of what you're going against for that. Now, if you have an investor that does have a long-term thesis, and that's, I think, what we all look for, you're 100% right. And a long-term thesis means equity value, but when equity value, you tend to look at the public markets and what the public markets are doing. And if you look at any of the public markets, especially the California public companies, it's just depressed. And so I think it's a real challenging basis in terms of how to get creative to be able to get the funding that you need to be able to keep the oxygen in your business.
But those short-term returns, that's debt. That's got to be debt.
It's not. There's great companies in like Missouri that are clipping out dividends because they're doing so well and everything else. So there's just it's such a high margin that there's cash being returned to investors on a quarterly basis, and that's what makes it challenging.
Yeah, I guess it depends on where you are in the market. Right. Yeah, I mean, I'm looking at margins in California too versus margins in like New York and New Jersey, and I just try to prep people in the Northeast and say, hey, you know what? Just don't get used to this. Let's get good business practices. Let's get them now because this isn't always going to last. And so, I mean, with that, Steve, I'd like you to chat about, companies. What are companies looking for when they go for investment? I see all different types of scenarios. I'll tell you one of my stories after this one, but so companies can be in different stages: distressed, startup. They could need working capital. They're actually looking for expansion. They're primed and ready for expansion. So if you want to talk about that, that would be awesome. Thanks, Steve.
No, absolutely. So I think anybody that's here that's looking for money, everybody's got their own journey. They have their own needs. And so I'm not going to spend a lot of time going in depth on trying to gap cash flow and talking about expansion and growth, whether it's geographic or whether it's with technology or operations. I think we all know that, right? I think the challenging part is what you're looking for when it comes to money is having the right investor. Having an investor that would actually take the time to do due diligence and ask for things like cash flow, and not get excited about even a big multiple exit, our promises or dreams, but somebody that will actually challenge your theory, methodology, your business strategy, and come at you in a way that's going to make you a better operator, taking that money, knowing that you could actually service it. So whether it's dividends, whether it's debt, however that's going to play into your strategy and your operation. I think, one thing that it's easy to do, and I think we all experienced it back in 18 and 19, is a lot of money came into the industry. We saw a lot of valuations go up, and then we all got caught short and lost a lot of money. And so I think we're at this point now that if you're, a really good strategic operator and you understand your financials and you could have proper due diligence, then you're going to get smart money and money that will work with you, and it's going to put less stress on you. Operating out of desperation, trying to make payroll, doing things like that, it's just, it's a recipe for disaster. So you got to take a step back and really understand how you're taking the money, who you're taking it from, what's it going to look like. And I've seen the MCA loans, I've seen the predatory, opportunities, and I think, again, I would like to see that go away from the industry. But sometimes it's a necessary evil, and it's worked with some companies. But again, I'll just stress the fact that you've got to really make sure that you're buttoned down for good due diligence and understanding all the risks and making sure you have the right investors.
So what's the difference between working capital and taking an investor, for example? I think a lot of people are in such a desperate situation that they don't really understand the difference. Go ahead.
Yeah, so let me jump on that. One thing that I think I've seen just in my experience, and I've been part of it, is you'll build out a C-suite for a company, you'll get really top heavy, and then you get forced into making irrational decisions trying to support that cost basis. And one thing, I'll just point out an example. Adam Banky, who's going to talk later today, when we co-founded High Road, it's just the two of us, right? So we're on the back office, he's the front end working with the team, and we didn't build up, a big management team because, what all companies really need to focus on, and you talked about it, is you got to race to cash flow break even as quick as you can and justify your existence. And so, I think the step is don't put yourself in a position to where you have to take predatory money. Be smart about, if somebody's not, killing what they eat, so to speak, and they're really bringing value to the operation, you need to take a hard look at your organization and make sure you have it structured properly, because as money gets smarter, it's really going to be challenging those things, and it's going to be hard to find unless you're operating that way.
I love that. Evan, how about, you want to talk from an investor standpoint? What are investors looking for that you've seen?
Yeah, I mean, it's a lot of the same, just the opposite side of it. We've had this period of irrational exuberance met with lack of governance, met with lack of operational efficiency and excellence, and we're kind of looking for the opposite now. Do you have operation efficiency and excellence? Do you have proper governance going to the management team? And then is there really something that's there for you to grow into? It's nice to have someone presenting a multi-billion, multi-trillion-dollar opportunity, and you're getting X% of that, and therefore it's Y valuation. That all sounds great, you get the money, now what are you going to do with it? How are you actually going to operate? What is built into your financial resiliency that you're not necessarily going to go off to sort of chase opportunities that aren't relevant to your core business today? So if you're thinking about cash flow neutral or positive, chasing the new opportunity, something shiny, the new product might differentiate you, but it might also not put any pennies to your bottom line, which is important. So from an investor standpoint, it's really going to be based on what you're looking for. If you're looking for a coupon, that's a different type of investment outlook than you're looking for, a sort of venture style growth return. That will dictate the type of operator. But all of them at this point require some level of commitment to operational excellence within a constrained, limited market. Because if you can get through that and build a playbook, then your brand is resilient, your operations are resilient, you have assets that are valuable, not just at sort of cost basis, but you can actually produce something with them. And that's really what investors are looking for. I think it's just looking at the opposite side of what an operator should be positioning themselves as today for long-term growth.
Yeah, and I just want to add something to that. As an operator and having a company, you also have to be in the world of reality when you're putting a valuation on your company. When you have investors coming and look, and kind of what you were talking about is, placing a bet on the dream, that's no longer in existence. So you got to really take a hard gut check on what is the real valuation. of your company when you're going out there to raise money, and make sure that you have some credibility from that standpoint. I've looked at a lot of opportunities, and a lot of them I walk away from a Cypress Ascendant perspective because the valuations are just not in reality. So got to really look at that and make sure you have that buttoned down.
Anybody else? How about the fundamentals like governance, management team, things like that? I feel like that's really important and often overlooked. So I guess let's start with management team. If you have a dysfunctional management team and you're looking for investment, how does it affect your ability to seek capital?
Well, as an operator entrepreneur, the first thing to think about is you're not building a company, you're building a team. A company is a team. And a company is only as good as the people that are within it, and it's really only as good as those people are willing to commit themselves and collaborate, cooperate, and drive towards a common goal. So team is number one. Hopefully, if you're a founder, you've identified individuals that will complement your skill sets, and you also understand your own strengths and weaknesses. I think that building a team, and if the team is weak, building an advisory board that can show strength to investors is very important. But then, as my colleague mentioned earlier, identifying investors that can be value additive beyond just a check, because that does help to add to your team. But also, they can also make recommendations on who you can bring onto the team to help assist in wherever you might have weaknesses. But building a team is challenging, and it takes time, and there's a lot of mistakes that any entrepreneur is going to make along the way, hiring friends or hiring people because of a resume, which I've made all of those, but there's a lot of pitfalls, but on the way you learn kind of what really makes a solid team and what makes good partners and good managers.
Go for it.
Yeah, I think there's a tough trifecta in cannabis where it's the expectation setting matters a lot, right? I give so much credit to everybody who is sitting in a CEO seat because it is so hard, and there's no investor or board member that can understand what you do every day. And there's no, your spouse, significant other, you can't tell people what it is. It's a lonely seat to be in because you're acting on, you're making 1,000 decisions on inaccurate data every single day without a playbook. And it's just hard, and it's time consuming, and it takes 15 hours a day, and it takes everything you have. And so when you take on an investor, right, when you're giving somebody some part of your company, that investor is going to try to be helpful. And more likely than not, they just know 1/100th of actually what's going on, and the amount of time and energy that you have to spend to be able to get them up to speed is just, it's a challenge, frankly. And so when you're an operator looking for cash for your business, I think that's why especially California companies have been so creative in terms of how to bring in that oxygen into their business. But so many times right now, back to Steve's point around expectations that haven't been set between the CEO, the board, and investors. So many investors I meet are like, hey, the CEO is terrible. And I always tell them, hey, I doubt it's the CEO, but here's what the market is, and here's what you don't know about that. But it's really important that you do have somebody as a CEO that can advocate on your behalf with investors, with a board, to be able to just give you breathing room to go get shit done that you want to do. You just want to do a good job, and you didn't get in here to update investors all the time. You got in here because you love the plant and you want to bring and make a meaningful impact to somebody else's life, and I think that's why we're all here. But it's just hard when you do that, and sometimes that investment's debt capital, and they're still asking, okay, here's what the interest rate is. Here's, when's this payment coming due? It's just it's a challenge when you're an executive doing that. So you really have to have that trifecta of the board, investors, and the management team all having the same expectations in terms of what success looks like.
I love that. That sounds like some closing remarks right there. So I'm going to start to the left. Real quick closing remarks.
Sorry,
Evan?
we don't have time, but
okay,
thank you, Rachel.
Well, thank you so much to our panel, and thank you to everybody in the audience.
Let's give it up for our panel. Thanks, everyone.
Thank you.